Hey guys, Taylor with GammaEdge here coming at you with the post-market recap for March 31st, 2025. Today can be characterized as a gap down and rally higher day. First day in a long time I can remember seeing this kind of constructive action if you're, dying to be a bull here. Generally, it's either been or gap higher, fade, choppy day, gap lower, chop. But just keep in mind, we are, downtrend since the peaks of February, middle of February. Everything we saw coming into today structurally, we're still pointing at put controlled market. So, one day does not reverse the trend by any means, but if we start to see follow through in the structure, market structure start to get more constructive, then we would change our tune, and we're going to go through our pre-market routine and what to specifically look for if that were to occur. So getting into our pre-market routine, one quick plug real quick. We have a free pre-market newsletter. We send you guys, the market trend model, different SPX visualizations, all that we're about to go through, basically about to go through our pre-market routine. So if you're interested in getting that, not currently a member, GammaEdge.us where you can sign up for that. So looking at this is our market trend model. This is how we gauge trend and momentum in the market, both on an intermediate or an intraday time frame and also a more swing trader time frame, which is, a day to a week. So it's coming into today, everything was just pointing lower, bearish conditions, puts clearly in control, sellers in control. And our market trend model that is built off the tick index. Simply put, that's just a measurement of buying and selling in the market. Go to Investopedia, you can learn more about the tick index itself. But what we do is we create something called the cumulative tick, which is this white bolded line, which that is really just the intraday tick that we create a time series out of. So we can look at this on a day over day basis, kind of understand trends in the market. So again, coming into today, late last week, ugly action, everything pointing lower. We also look at what we call the filter tick, which is the tick index, and when there are tick readings plus or minus 1,000, which is just a kind of standard industry benchmark, then this will register and fire either lower or higher. So we can see last week there was net selling Wednesday, Thursday, and Friday. Lastly, market breadth, measurement of 52-week new highs versus new lows. New lows were outpacing new highs. After understanding the market trend model, we then go to the SPX options complex. We looked to understand positioning as the options market are inherently forward-looking, right? So we want to see how those call and put speculators are positioned to see who are in control of the structure. Now, the SPX, we break that into two separate components because there are two components. If you didn't know that, there's the SPX-A, the SPX-P. We'll go over the SPX-A first, which you can think of this as your cruise ship. The reason for that is A is a lot bigger than the SPX-P, and this is more kind of longer-term institutional money that plays in here, as these are your monthly and your quarterly expirations. So coming into today, structure, all you see is red, put dominated. That's really all you need to know here. So we have a downtrending market trend model, SPX-A, the cruise ship that is put dominated. So, if you're a swing trader, this is not an ideal market conditions for you to be executing those trades, assuming that you're wanting to get long. So this is a great way to view the market through that lens of the options market to get that understanding. And just so you have a reference point, here is a structure that is call dominated. Again, here you see green everywhere. Calls are in control. This is a structure that we want to see when we think that conditions are more favorable for a progressive move higher. This is just essentially bullish foundation. And then note along the same time period how the market trend model is moving higher, like so, and that is definitely not what we have right now. So until we get more conditions looking like this where the market trend model is moving higher, call dominated structure, not constructive for swing trading again. So again, next what we do is we go to the SPXP. This you can think more of as a cigarette boat. Reason for that is because A, it's a smaller structure, but keep in mind SPXP, SPXA, that's still where a significant amount of speculation is taking place in the market in terms of the size and liquidity offered within the SPX for options traders. So right in the SPXP, that is comprised of your daily and your weekly and your 0DT expirations. So that's much more where short-term active traders participate. And again, this structure is put dominated coming into the session today. Again, a lot of red everywhere. And we also layer on top of that what we call our transition zones, which these are key price zones or areas in the structure to where there is a kind of fight, I guess, for lack of a better term, going on between call and put speculators. And the general characteristic of price action in this zone is chop. One reason for this is because market maker dealers are not experiencing a lot of pressure or need to hedge their risk one way or another. So price is able to freely kind of do what it's going to do. And above this level, this is where we expect to see calls start to take more control of the structure and price itself, and we expect to move higher. And below this level, we expect puts to remain in control and price to have a downward bias. Now, keep in mind the distance from the transition zone is critical because you can think of it as a rubber band. And the further that we get away from that rubber band, right, it's getting stretched and stretched, and eventually it's going to come back. Reason for this is, think about it, all these puts right here are in the money. Eventually they want to realize those profits. So, the risk there is when we're, extended down here is a monetization event. So, when people say don't shorten the hole, this is kind of a visualization of that. So yes, while the market trend model was trending lower, SPXA, SPXP were put dominated. On the SPXP timeframe, we were quite a bit extended from the bottom of the transition zone. Now, that doesn't automatically mean that we're going to get a mean reversion move higher, but we need to be cognizant and have that market awareness that that is a potential play for the day or for the upcoming days. Now that we kind of have our structure and sentiment in place, next thing that we do is we go and we focus on the 0DT, because we realize not everyone is a swing trader, and the SPX 0DT complex is kind of its own animal. So here, coming in the day, we were put dominated above, call dominated below. That's kind of the standard setup for the 0DT complex. However, note our transition zones. Again, here the purple, that is the DEX transition zone based off delta. Bottom of that was 56.35. Then we also have another transition zone that we refer to as the drunken sailor zone. We refer to this as the drunken sailor zone because it's within the context of the DEX transition zone. So again, that's where we expect choppy price action, because there's a back and forth between call and put dominated strikes. And second is, if even when we break above and below the DEX transition zone, we could still be in the context of the drunken sailor zone. And this is characterized as an area where, while those strikes could be call or put dominated, there is not a significant amount of that speculation there. So the intraday volume and the actual opening and closing of contracts is going to influence spot price a lot more than those dealer market maker hedging dynamics and the moneyness of the options decaying to zero, limiting to one. And again, here coming into the day, we were gapping down to 55.27, I think is where we opened. So again, we were significantly extended from the bottom of the transition zone. So again, all of these puts that were out of the money are now in the money. All of that out of the money risk has been realized. They're sitting on a significant amount of gains. And then again, just the nature being 0DT, they want to lock those gains in. So a monetization event is something that we need to have in the back of our mind that could occur. And that is where our intraday volume analysis is key, that we will get into in a minute. So with that, we've been through the market trend model. We've been through both the SPXA, SPXP, and now we've been through the 0DT. So we have our key levels and we have our key kind of backdrop and who is in control of the markets. One other thing I wanted to hit on real quick is this is what we call our net stack command. And what this is a summary, a visualization of all four major Greeks. Delta being the first order, charm, gamma, and VAMA being the second order Greeks, meaning those directly influence delta itself. Remember, delta is mostly influenced by the opening and closing of transactions on the 0DT basis. And so here, simply put, the dominant strikes that we were being aware of at the open were 5,500 to the downside, and then 55.65 to the upside, which again, that was a JPM hedge strike today that did roll. So here are those levels visualized on the price chart. So we have the drunken sailor range, which is this teal box. We have the DEX transition zone, which is the purple box. You can see we gapped way below that. This key level right here, this is the 5,500. 55.65 was this key level. Then 55.50 was another key strike in the complex that we wanted to be aware of, because those whole and half levels, that whole level being 5,600 or 55.50 is the half level. Those are key kind of psychological levels where we often see price interaction at those levels. So again, right here's the 5,500 level. Remember, that was that key strike with our net stack command. We were not able to, substantially take that level out. And then again, we were cognizant, right, that we were gapping down so low that could be some kind of monetization event pushing us higher. So right, price action, we chopped between the 5,500, 55.65. Those were those other two key strikes we identified. Once we were able to move through 55.65, then up to the bottom of the drunken say the range was the next kind of logical level. Yes, that's great. Price, went and, kind of interacted with our key levels, but is there a way to help us kind of understand if we should have expected this kind of trending action throughout the day, or if we should have expected choppy action? And that is where our intraday volume analysis comes into play, which did confirm this. And that is what this chart is here. We call it vol M. Effectively, what it is on a 5-minute basis throughout the session, we are looking at the total call and put volume. We are looking at the distribution of that. We are finding the center of that distribution, which we refer to as a centroid. We plot those centroids every 5 minutes, then we connect the lines for you so we can kind of understand trends throughout the day. And then we apply these dashed lines, which are our lines of best fit. They're just simply, linear regressions, which can kind of help us plot out where price is expected to go based off of what has happened in the past. So you can think about it this way, like the vol M chart at noon, the centroids were going like this, put centroids were going like this. So at noon, we would expect that trend to continue, which is what it ultimately did. And so you can kind of visualize with this chart how that is useful on an intraday basis to help us understand, are we seeing upside speculation? Are we seeing choppy? Or are we seeing downside speculation, which helps us confirm those intraday price actions lower or higher. And then we can layer in that with our key levels we've identified to help us trade against, size risk against. So just so you guys can visualize what that looks like, and I know that was the end of day chart, so it's kind of hard to understand, and a lot of hindsight bias that went into that. But here's that chart, which was at noon that I was discussing. And here at noon, what we could see is for the call centroid sign, these centroids were flat to higher on the session, and then the put centroid side that was ramping higher. Right, so that kind of gave us the knowledge that we were not seeing any significant downside speculation from the put side, and on the call side, we weren't seeing any downside speculation as well. We were seeing flat to moderately higher. So that kind of told us, there's probably a little bit of a cap on the market. It's from expecting like an explosive move higher, but nonetheless, our bias with this is sideways to higher. And then, if you're a credit spread trader or something like that, you can kind of understand where the upper bounds of the market are. And at this point too, credit spread trader, kind of also understanding that the general trend of the market is higher as well. So there's a bit of comfort, of selling below these centroids, above those centroids, just kind of giving you an actual way that people like to use as tools. Or you could be, an intraday scalper, understanding, if the trend of the market is higher on an intraday basis, then you want to potentially be finding those higher lows to scalp against, or at least scalping kind of in the direction of price action, which was higher on the day. And then again, we produce this GIF, which is just stitching each of those 5-minute vol M's that we produced throughout the session. So, looking back on the day, you can just see how that build out was building higher on the day on the call side, eventually flattening out, but that put side was trending higher as well. So again, hopefully this tool, you're kind of understanding its utility on an intraday basis to help us kind of confirm the potential price path through the close. And then just a couple of trade examples for you guys today of what you could have potentially done. Or like myself, what I did, we were just talking about in the Discord how everything was moving higher. Be remiss if we didn't talk about the market trend model. Looking at today's action, which is this right here. Granted, it's not, an aggressive move higher, but we are moving higher throughout the session. We did see some late intraday buying in the session as well. Keep in mind, market breadth was still awful, but we're trying to flip that very short-term trend. So it's critical that we see an expansion move higher, a bit of follow through. So again, coming back to this, we knew that the general speculation of the day was higher. So I was kind of looking long, a way to get long. Was not able to get long just through this because kind of for all intents and purposes, a bit of a lockout rally here intraday, and we were kind of between key levels, a bit of no man's land. So, chop could have been expected here, and that would have been completely normal. But what I did is I took this higher low off the 5,500 strike because that's, that was a key level we identified. Easy way to gauge risk. Expected to move up to 5,565, which is exactly what we got. So just a quick little scalp there. That's really all you need in a day, right? It's just one good trade. And then, we just got a lot of chop between these two key levels, which was completely rational. And then I did not take this trade full of transparency, but once we got that break retest, push higher off 5,565 up to the bottom of the drunken sailor zone, then you see that there is clear respect for this level here. So again, a couple different trade ideas for you. Or, if you're a credit speller, I mean, there are a lot of great opportunities to, sell spreads into higher lows, knowing that, the vol M was trending higher throughout the session. And so looking forward, where do we go from here? Again, want to see that market trend model progress higher. Looking at our dashboards, we want to see the SPX A complex, SPX P complex start to thaw out. And by thaw out, I mean that call speculation come back into the markets, or at least that put speculation start to lead the markets. Again, one day does not start a new rally higher. We know what our market kind of turning framework looks like, which is what I just went through. So until we start to see the tides turn, I'm personally still going to be focused on just kind of scalping intraday stuff until the environment becomes a lot more conducive to actually having confidence in that bullish structure to put on swing trades. So with that, hope you guys found this useful, found kind of our playbook, our methodology, our tools, and how we understand what the trend and momentum is, what call and put speculation is doing to give us an idea of bullish and bearish conditions. And if you want to find out more about us, embedded in the comments on YouTube, we have curated playlists for you that kind of go over some of our tools and actual ways to use them. And then a link to our website where we have 2 free newsletters I talked about, pre-market and a weekend educational newsletter. And then we also have a couple different courses. One of them is our flagship course where we teach you everything about our methodology for free. So, if you're interested in this, feel free to take advantage of that. With that, I will see you all tomorrow. Bye.